Netflix just reported earnings and the stock popped over 10%. The number of paid subscribers on the platform increased by 9 million to a record 247 million. Total revenue increased by 8% year over year and operating margins hit 20%. These numbers are all above previous forecasts. In addition, Netflix thinks this year's free cash flow will now hit 6.5 billion, another record. Based on the latest share price, the company is now valued at $175 billion, which means it's trading at 6 times annual revenue, 39 times earnings, and 28 times this year's free cash flow. So this looks like a good report from Netflix, which many investors weren't expecting. The company is benefiting from its new advertising program and strong engagement from its shows. In the US, Netflix had the most watched original TV series for 37 out of the first 38 weeks of the year. Suits proved to be a big hit, and the company has more content in store, such as the final season of The Crown and a new Squid game. The company is even rolling out physical destinations, which it's calling the Netflix House. And Netflix management has also bought back an impressive number of shares, about $3.5 billion worth over the last year. However, it's not all good news. Netflix's revenue growth has been helped by the clamping down on password sharing within households. Once this rollout is completed, that boost to revenue will die down. Second, Netflix's free cash flow was helped by a $1 billion reduction in content spend, a direct result of the actor strikes going on in Hollywood. Spending should increase from $13 billion to $17 billion next year once the strikes are resolved, and that is going to have a huge impact on free cash flow. Meanwhile, data from Nielsen shows that Netflix's percentage share of TV viewing in the US dropped by 4 percentage points, with YouTube and Amazon Prime making strong headway. So let's assume that Netflix can grow its top-line revenue by 12% per year for the next 5 years and operate with an 18% free cash flow margin. In that scenario, the company would be producing 10 billion of free cash flow in 5 years' time, and a 25 times multiple would put the valuation at around 260 billion. That works out to an investment return of 8% per year. Share buybacks could help push that above 9%, but even so, the upside doesn't look huge. But returns could increase if Netflix is successful at raising prices. US premium will be going up to $22.99 a year and UK premium to $17.99. It's going to be interesting to see how customers respond, given the vast amounts of content that is now available elsewhere. Overall, Netflix will continue to be the key player in online streaming, but the stock doesn't present a compelling opportunity, which is why I give it a neutral rating. But these are my personal opinions, not financial advice, and I've got no position in the stock. For more detailed investing ideas, check out our website, overlookedalpha.com.